Hello everyone, welcome to our video today, where we'll be discussing The Little Book That Beats the Market by Joel Greenblatt. This book is a classic in the world of finance and investing and has been praised for its simplicity and practicality. In this video, we will be going through each chapter, explaining the key points, and giving examples to make it easier for you to understand. So, let's dive in. Chapter 1, The Magic Formula is the first chapter of Joel Greenblatt's book The Little Book That Beats the Market. In this chapter, Greenblatt introduces the concept of the magic formula, which is a systematic approach to investing in the stock market that is based on two key factors: a company's earnings yield and its return on invested capital. The earnings yield is calculated by dividing a company's earnings before interest and taxes by its market capitalization. The return on invested capital measures how much money a company generates for each dollar invested in the business. Greenblatt's magic formula is simple: invest in the companies that have the highest earnings yield and the highest return on invested capital. These companies tend to be undervalued by the market and have the potential to outperform in the long run. Example: imagine that you are considering investing in two companies, Company A and Company B. Company A has an earnings yield of 10% and a return on invested capital of 20%, while Company B has an earnings yield of 5% and a return on invested capital of 10%. According to the magic formula, you would want to invest in Company A because it has a higher earnings yield and a higher return on invested capital. By using the magic formula, investors can identify undervalued companies that have the potential to generate strong returns over time, making it a profitable and effective strategy for investing in the stock market. Chapter 2 of The Little Book That Beats the Market by Joel Greenblatt focuses on how the magic formula, introduced in Chapter 1, actually works. In this chapter, Greenblatt provides a detailed explanation of the magic formula's two components: earning yield and return on capital. Earnings yield refers to a company's earnings divided by its market capitalization. The higher the earnings yield, the more attractive a company is considered. Return on capital refers to the amount of profit a company generates relative to the amount of capital invested in the business. The higher the return on capital, the more efficient a company is at using its invested funds to generate profits. By combining the two components, the magic formula helps to identify companies that are both profitable and efficiently managed. These companies are considered to be the most attractive investment opportunities. Example: consider Company A and Company B. Both companies have similar market capitalizations, but Company A has an earnings yield of 10% and a return on capital of 15%, while Company B has an earnings yield of 5% and a return on capital of 20%. Based on the magic formula, Company B would be considered the more attractive investment opportunity, as it is both efficient in its use of capital and generates a higher return. Chapter 3 of The Little Book That Beats the Market by Joel Greenblatt is focused on explaining how to implement the magic formula in your own investment strategy. The chapter covers the following key points. 1. Identifying companies. To implement the magic formula, you need to identify companies that have high earnings yields and a strong return on invested capital. 1. The magic formula score, which is the combination of both of these metrics, will help you find these companies. Example: a company that has a high earnings yield of 20% and a strong return on invested capital of 40% would have a magic formula score of 60%. This score indicates that the company is a strong candidate for investment using the magic formula. 1. Screening companies. Once you have identified the companies, you need to screen them to determine which ones are the best investments. 1. The magic formula provides a ranking system to help you determine which companies are the most attractive. Example: if you have a list of 20 companies and the magic formula score ranks them in the order of 60, 50, 45, 40, etc. The company with the highest score of 60 would be the first company you would consider investing in. 1. Building a portfolio. Finally, you need to build a portfolio of these companies to maximize your returns. 1. The magic formula suggests that you invest in a number of companies to reduce the risk of loss. Example: you could build a portfolio of 10 companies using the magic formula score and allocate equal amounts of money to each company. This would provide you with a diversified portfolio that should generate strong returns over the long term. By following these steps, you can implement the magic formula and start generating strong returns on your investments. In Chapter 4 of The Little Book That Beats the Market, Joel Greenblatt covers the topic of understanding and analyzing financial statements. He explains that in order to make informed investment decisions, it's important to have a basic understanding of the three main financial statements: the balance sheet, the income statement, and the cash flow statement. For example, the balance sheet shows a company's assets, liabilities, and equity at a specific point in time. It provides information about the company's financial structure and solvency. The income statement, on the other hand, shows a company's revenue, expenses, and net income over a specified period of time. This information is useful for determining a company's profitability. Finally, the cash flow statement provides information about a company's inflows and outflows of cash and helps investors understand a company's financial flexibility. Greenblatt explains that by studying these financial statements, investors can get a better understanding of a company's financial health and make informed decisions about whether to invest in the company or not. It's important to understand that these statements should be analyzed over time to get a full picture of a company's financial situation. In Chapter 5 of The Little Book That Beats the Market, Joel Greenblatt explores the art of valuation. He explains that the key to successful investing is to buy stocks at a price that is lower than their intrinsic value. In other words, an investor should aim to buy stocks for less than what they are actually worth. For example, let's say a company is worth $100 million, but its stock is only trading at $70 million. A smart investor would recognize that this stock is undervalued and buy it, with the expectation that its value will eventually rise to its true worth of $100 million. This is the essence of the art of valuation, finding undervalued stocks and investing in them for the long term. Greenblatt explains that there are several methods for determining a stock's intrinsic value, including analyzing its financial statements, looking at its price-to-earnings ratio, and using a discounted cash flow analysis. Understanding these methods and applying them to potential investments is crucial for a successful investor. In Chapter 6 of The Little Book That Beats the Market by Joel Greenblatt, the author focuses on how to avoid the pitfalls of investing. He highlights the common mistakes that investors make and provides examples and solutions for how to avoid them. For example, one of the biggest mistakes investors make is buying high and selling low. This occurs when an investor buys a stock at its peak and then sells it when the stock is at its lowest. To avoid this pitfall, Greenblatt suggests investors stick to the magic formula and only invest in companies that have a high earnings yield and a high return on invested capital. Another pitfall that investors fall into is being influenced by the emotions of fear and greed. Fear often causes investors to sell their stocks at a loss, while greed can lead to overpaying for a stock. Greenblatt recommends investors to focus on the fundamentals of a company and not be swayed by emotions. Lastly, Greenblatt cautions against the pitfall of following the crowd. He explains that many investors tend to follow popular trends, but this can lead to a blind investment in overpriced stocks. Instead, Greenblatt advises investors to stick to the magic formula and invest in companies that have a high earnings yield and a high return on invested capital, regardless of popular trends. By avoiding these common pitfalls, investors can increase their chances of success and achieve their financial goals. In conclusion, The Little Book That Beats the Market is a must-read for anyone who wants to learn about investing and finance. By following the magic formula, investors can find undervalued companies that have the potential to generate high returns over the long term. We hope this video has been helpful in explaining the key concepts from the book, and we look forward to your feedback. Thank you for watching.